Welcome to Profit Mindset. Here, we break down finance in simple words, from banks and bonds to stocks and the markets. If you want to truly understand how money works, make sure to subscribe. And now, let's begin. Most people think money just sits in the bank and grows by itself, but that's an illusion. Banks rarely send money abroad. It usually circulates within the country. The real magic happens when money moves through securities, stocks, bonds, and markets. That's when international finance begins. Businesses grow and stock exchanges come alive. Securities are simply documents. They prove you have given money to a government, a city, or a company. In return, you receive interest or a share of profits. Most importantly, you have the right to demand your money back. For example, a bond is like an IOU. You lend money and they must repay with interest. A share, on the other hand, is not a debt, but ownership. Buy a share and you become part owner of a business. If there's profit, you receive dividends. Governments borrow money all the time, sometimes for useful projects like railways, canals, or power stations. That's productive debt because it pays back in the future. But often the money goes into war and weapons. That's deadweight debt. Factories work, ships are built, but once the war is over, there are no railways, no infrastructure, only debt. A classic example, in the 19th century, Britain borrowed heavily to build railways, and it paid off. France, however, poured money into wars and was left with debt but no return. When governments need money, they issue bonds. Banks distribute them. If not enough people buy, banks guarantee the issue by taking the rest themselves. That is called underwriting. But banks do not take risks for free. They charge fees. Sometimes governments force citizens to subscribe, making it a hidden tax. But usually it is voluntary. Banks promote bonds with advertising, newspapers, and even patriotic slogans. Imagine the king of Ruritania wants a battleship. Raising taxes would cause revolt, so the government issues bonds. Banks buy the first batch, newspapers shout, support your country, citizens invest, shipyards build, workers get paid, investors receive interest, and the king gets his battleship. Ordinary people cannot go directly to a king or finance minister to buy bonds. Banks act as intermediaries. They take risks, organize distribution, and create trust. Without banks, the system would not work. If a government announces a loan and nobody buys, that is a failure. But if banks guarantee the issue in advance, the state can raise money safely. For companies, the situation is more complicated. Governments almost always pay their debts. Companies can fail. That's why company capital is divided into three categories. First is bonds, which are like loans where investors expect fixed interest. Second is preference shares, which provide a fixed dividend but no voting rights. Third is ordinary shares, which give both voting rights and dividends, but only if profits remain. Take a brewery as an example. It wants to expand. It issues bonds. Investors receive 5% guaranteed. It issues preference shares. Holders get a fixed dividend, even in a bad year. Ordinary shareholders take the greatest risk, but in a good year, they may earn the biggest dividends. All securities can be bought and sold on the stock exchange. That is their main advantage compared to a simple IOU to a neighbor. Their value is not only in income, but also in liquidity, the ability to turn them into cash quickly. Price depends on demand, expectations, and even rumors. Sometimes it makes no sense. Shares in a mine may skyrocket before gold is found, or collapse because of gossip even if the business is stable. The stock exchange is not just economics, it is crowd psychology. So, let's recap. Governments borrow either for railways or for wars. Bonds and shares carry different levels of risk. Banks connect savers and borrowers. The stock exchange makes securities liquid, but also volatile. Investing itself is simple. The hard part is controlling greed, and that is what ruins most investors. Invest wisely, with reason, not emotion.